I'm going to do a little bit today, more of a kind of explainer on curve flattening, because this has been something that has come up a lot recently. And obviously I'm sure most people have read anything in the news about the Fed and what's gone on recently. I'm going to want to know what curve flattening is, what it means, what it implies, what's happened. So I'll try and talk you through this without overcomplicating things and try and make this as simple as possible, as well as what markets do you want to look at? How are you going to see this? Because that's ultimately the thing that you need to know. You need to know what's happened in this flattening play and then how this either continues or how this then reverses. So, curve flattening. Quite simply, if I draw you a little picture here, what people are talking about when they talk about curve flattening is yield curve. And I'll show you yield curves in a moment over the course of this year. Now, the way a yield curve works is it gives you the yield on every bond, from anything from a 1-month bond to a 2-year, to a 10-year, to a 30-year, and onwards, depending upon what country you're in. The 1-month bonds are going to be related closely to, in this case, the Fed's rate, or the Fed's target rate, so 0 to 0.25. And then the further out you go, you have to factor in inflation, because inflation erodes the value of your money the further out in time you go. Shorter end, inflation is going to have limited impact on your money. If you've got £10 today, it's probably going to buy reasonably close to the same things that £10 will buy tomorrow. Over 30 years, things change quite significantly. I couldn't drive 30 years ago, but I remember even when I first started to drive, petrol in the UK was under £1 a litre, and in fact I think it was under 80p a litre in some places. Now you'll struggle to get petrol for under £1.30. So a pretty significant jump in inflation. So therefore the value of my money effectively is eroded. That's what you have to factor into the longer end of a curve. Right, so what curve flattening is you take a yield curve that looks like this, or to get in this example, yield curve looks like this. You expect to get a higher yield on a longer duration bond. Why? The higher yield has to counter the impact of inflation and also has to factor in a little bit more of creditworthiness as well. In 10 years' time, you can be less certain that a country's going to pay you back the money you've lent them than you can in 1 month's time. Take America, they're not going to go bust next month. And it seems reasonably clear, looking at any information you've got, that's not going to happen. 10 years' time, still probably not, but the probability is slightly higher, so you command a little bit higher rate. So this is a pretty typical looking yield curve. Now what's happened since the Fed is this has flattened. So I think most people, basic idea of drawing, can understand that a curve that flattens has effectively moved down here, or moved up here, or both. What we've in fact had is a curve that has done this. So this has flattened both ways. The short end has risen, the longer end has fallen. In the initial move, you saw everything drop in terms of, and so, sorry, just very quickly, this is yield, so yield rising, just before I start saying everything dropped. So when you had the Fed, or post the Fed, what you had is all of the short end bonds and all of the longer end bonds all dropped together. So what this is what's called a bear flattening move. The bonds have sold, so it's a bear move, and that has flattened the curve. Because what's happened is the shorter end has sold off faster and further relatively than the long end. So what this effectively does is drives up the short end relative to where it previously was, and drives down the long end. The implication of this is that rate hikes are coming sooner than people thought. And what rate hikes lead to is lower inflation over time. So you end up with both sides of the curve flattens out. What we've seen since then is then a re-steepening slightly as you've had a sort of pullback on these types of moves. So let's go and have a little look at what exactly has gone on then. Basically, thing to quickly think of here, bear flattening, you're selling bonds. This generally implies that rates are going to be rising sooner. And also that inflation is not coming as a result of that. Whereas you can have a bull flattening move. So what a bull flattening move does is it effectively flattens the curve by buying bonds. So what's happening here is the long end is going up faster, which suggests that rates aren't rising, but inflation's actually falling. This is how you can end up leading or rolling into an inverted yield curve, as the perception of inflation and the growth in the economy falls over time, and you can end up with a curve that looks more like that. So it's not so much that the long end has necessarily changed. If we draw it like this, it wouldn't be that the short end has necessarily changed that much. It's that maybe you've actually moved to a curve that looks like that, which is basically an indication the economy is not doing so well. Right, you can see this, and I think the easy way to look at this, if you want some ladders or charts up, look at it as the spread between a 2-year and a 10-year. That's going to be the easy one to be looking for. The fact that this isn't implying rate hikes are coming sooner, this is also showing up as reasonably good for currency. Higher rates means that you can put money into short-term deposits in the US and earn more money on it. What you've got to remember here with the currency play is that it is playing on the basis of expected higher rates. So you put your money in now so you get higher rates in future. This is why it's good for euro and why you've seen this strong move in the euro. So, just to illustrate this in terms of markets, what I've got here is a 10-year, a 5-year and a 2-year. Whoops. This is what's happened then. On the Fed, just here, you get a drop in everything. Not a surprise. But what you've had is a more severe drop in the 2-year than the 5 than the 10. And so as the week went on, as the days went on afterwards, so consolidation in the 5-year, reversal in the 10-year, consolidation in the 2-year, you then get on Bullard's comments, where he talked about a hike in 2022, you actually then got sell-off in the 5-year, sell-off in the 10 that reversed, and then a sell-off in the 2-year that stays down. So if you just have a look at where everything is in comparison to the Fed, in comparison to, there's the Fed, there's Bullard's comment, there's the Fed, there's Bullard's comment, there's the Fed, there's Bullard's comment, and just look relative as to where everything is. The 10-year is back above, or went back above the Fed. The 5-year didn't, the 2-year nowhere near. And further to that, since Bullard's comment, the 10-year has gone back above there. 5-year has just got back there, 2-year still below. So this is showing you that you're still seeing this short end of the curve is still that little bit higher. Long end has reversed back up. So therefore, this is what gives you the bear flattening. So what you can now see is how this can change as well. So watching these three markets together is a very useful thing over the next few days, the next few weeks, to see the relative shift in these. If you suddenly start seeing the 2-year turning this round whilst the 10-year stays down, whilst the 5-year stays down or even starts to drop, all of a sudden you're seeing the re-steepening of the curve. So just to give you a little bit of context, this is where we are or have been yield curve wise. So there's a couple of little bits I should point out. What we've got, purple is January, green is March, and what we had at the beginning of the year was this steepening in the yield curve. Expectation of inflation rising, which we have seen, and potential taper. So people selling longer end bonds. Not too much worried about a rate move. No one was expecting the Fed to change rates at the beginning of the year, or going into the beginning of the year. Since March, we've seen a flattening. So go to the blue, and you see, particularly in the long end, the curve has started to flatten back, but not a great deal of change in the short end. No one's expecting a change. Get to the current situation, and you see the long end further dropping, but ultimately has pretty much come back to where it was. But the short end, if you look particularly right down here, the orange, which is current, is above where we were in March and where we were pre-Fed. What you also see is everything out to a 7-year is also trading above, yield-wise, the rate that it was in just a couple of days before the Fed. So that's the idea of a flattening. It doesn't look so clear on this because the short end rates, you get lots of short end rates. So you got 1 month, 3 month, 6 month, 1 year down here, and then the rates start to go up much quicker as the distance between years increases, which is why it looks more dramatic. But what you are looking at here is the fact that the shorter end rates, so anything out to a 7-year, are all higher than they were. Anything beyond 7-year are all lower than they were. So this is quite a distinct flattening just from the beginning of last week and very clearly from the beginning of March. And this is the impact it's had on dollar. As soon as you got that hike, you then get, so this is the Fed. Fed tends to move down. Unlike everything else that's stabilised, or relatively stabilised, and so this is where you got the news move and then the flattening move. That the day after the Fed, you saw the T-note start to reverse. You saw the 5-year ticking back up and the 2-year stabilising at lower levels. This is the flattening part. This is then the pricing in of that rate hike over the next day or so, and hence why the dollar continues to strengthen and then continues to strengthen further. So what you're looking out for now, keeping your eyes on those relative changes in those markets. You start seeing the 2-year pushing up and up and up and up. This then starts to reverse that back and could end up now instigating a reversal as that rate hike gets slightly priced out. So that's what you're looking for. Hopefully that's explained curve flattening situations in a little bit more detail. If anyone wants anything else explaining over the coming weeks, drop me a message, info@AXIA Futures. I'm actually not here next week, I'm on holiday, so it will be the following week. But drop me a message and I will try and get anything covered for you. I'll leave you there, guys. Have a great rest of your day's trading.
If you find this video interesting, if you want to go deep into the AXIA training method and how our trading team of 7-figure traders develop setups and strategies and how they learn to build the most profitable trades across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.